Good morning, everyone, and welcome to the Pinnacle Financial Partners Fourth Quarter 2019 Earnings Conference Call. Hosting the call today from Pinnacle Financial Partners is Mr. Terry Turner, Chief Executive Officer, and Mr. Harold Carpenter, Chief Financial Officer. Please note Pinnacle's earnings release and this morning's presentation are available on the Investor Relations page of their website at www.pnfp.com. Today's call is being recorded and will be available for replay on Pinnacle's website for the next 90 days. At this time, all participants have been placed in a listen-only mode. The floor will be open for your questions following the presentation. If you would like to ask a question at that time, please press star 1 on your touch-tone phone. Analysts will be given preference during the Q&A. We ask that you please pick up your handset to allow optimal sound quality. Before we begin, Pinnacle does not provide earnings guidance or forecasts. During this presentation, we may make comments which may constitute forward-looking statements. All forward-looking statements are subject to risks, uncertainties, and other facts that may cause the actual results, performance, or achievements of Pinnacle Financial to differ materially from any results expressed or implied by such forward-looking statements. Many of such factors are beyond Pinnacle's financial ability to control or predict, and listeners are cautioned not to put undue reliance on such forward-looking statements. A more detailed description of these and other risks is contained in Pinnacle's financial quarterly report for the quarter ended June 30th, 2019. Pinnacle Financial disclaims any obligation to update or revise any forward-looking statements contained in this presentation, whether as a result of new information, future events, or otherwise. In addition, these remarks may include certain non-GAAP financial measures as defined by SEC Regulation G. A presentation of the most directly comparable GAAP financial measures and reconciliation of the non-GAAP measures to the comparable GAAP measures will be available on Pinnacle's financial website at www.pnfp.com. With that, I am now going to turn the presentation over to Mr. Terry Turner, Pinnacle's President and CEO.
Thank you, Cherie. Good morning. As we always do, I'll begin with this dashboard. As a reminder, it's typically focused on revenue growth, earnings growth, and asset quality because we continue to believe that they're the three most highly correlated metrics to long-term shareholder returns. Q4 was a good quarter for our firm. We continued to have strong balance sheet growth. Already great asset quality got even better, and despite a little contraction in revenue and fully diluted EPS sequentially, we still had 2.5% year-over-year growth in revenue and 2.4% growth year-over-year growth in EPS. Due to all the noise and adjustments, primarily in previous periods, in many cases the non-GAAP measures may better illustrate the relative performance of the firm. As a reminder, the reason we begin each quarterly earnings call with data that goes back 5 years is because, as you can see, irrespective of M&A impacts, deposit betas, outsized prepayoffs, or any of the other hot buttons that have come and gone, our balance sheet growth, and until this quarter, our growth in revenue and EPS have been remarkably rapid and reliable. In 4Q19, we continued our share-taking balance sheet growth. However, as I mentioned on the last slide, despite being up year-over-year, both revenue and fully diluted EPS declined on a sequential quarter basis. My hope is that that's not a surprise to anyone. I believe we had adequately signaled to the market last quarter that would be the case, largely as a result of two key reasons. Number one, BHG is in the process of converting a greater volume of their originations to hold on their balance sheet as opposed to selling them through their auction platform for immediate gain. From 30,000 feet, we agree that increasing the spread business should result in a more valuable franchise, so we're supportive of that. I'm also happy to report that regardless of the increase in production for their balance sheet and the associated reduction in gain on sale revenue that found its way to our P&L in the fourth quarter, 2019 originations for BHG were at an all-time high, and that's where the value is created in that firm. So we continue to expect that line item to be up 8 to 12% or so for 2020 over 2019. Harold will cover this in greater detail in just a minute. Of course, the second major impact came from contraction in the net interest margin. Despite the contraction in NIM, we made great headway on cost of funds in 4Q19 and expect further headway in first quarter of 20, believing we may find the floor for our margin sooner than we had anticipated. Harold will also comment further on this momentarily. As it relates to asset quality, virtually every quarter we report that there's only one direction for asset quality to move, but believe it or not, we saw still further improvement in our already strong asset quality metrics in 4Q, with meaningful reductions in non-performing assets and net charge-offs during the quarter. I know by now everybody's familiar with the business case that we made for the BNC acquisition. As you recall, the plan was to continue the high-growth CRE platform that BNC had built and bolt onto that a C&I platform, which is the principal strength of our firm. The critical path to make that happen was to lever our ongoing recruitment competence in order to attract and retain the best C&I and private bankers in the market. Specifically, we had said we'd hire 65 of them over a 5-year period of time. As you can see, Rick Callicutt and his team surpassed the hiring target at this point in the plan by more than twofold. The environment for hiring great bankers in the Carolinas and Virginia has only gotten better since we launched our transaction there. One of the reasons that I chose to continue to highlight this in fourth quarter is that it demonstrates just how vulnerable those banks are that dominate the Carolinas and Virginia and Atlanta. And consequently, that bears on our belief about the magnitude of the opportunity that we see in Atlanta. Later, I'll discuss our target markets, the rationale for them, and more specifically, our focus on Atlanta. But I want to at least highlight the magnitude of the opportunity we see in our existing footprint by virtue of our overlap with Truist. 91.5% of our existing offices are within 2 miles of a Truist location. So we believe we're extremely well positioned to capitalize on any vulnerability encountered as a result of that merger. So our outlook remains extremely optimistic. That's it from 30,000 feet. Let me turn it over to Harold to review the quarter in greater detail.
Thanks, Terry. Good morning, everybody. We've updated this revenue per share slide for fourth quarter results. As you can see, we continue to experience year-over-year double-digit revenue per share growth. The red dotted line represents the peer group's year-over-year growth. We outpace our peers on revenue per share consistently by a wide margin. Our relationship managers have remained focused on gathering clients and generating incremental revenues for our firm. Obviously, BHG's performance has had a meaningful influence on these results. As we have mentioned before, we don't apologize for that at all. We continue to expect 8 to 12% revenue growth from BHG in 2020. Even though BHG was down in the fourth quarter, BHG will be back in the coming quarters. As you know, BHG has afforded us opportunities to invest in our franchise as well as provide significant tangible book value accretion. We're also excited about de novo expansion into Atlanta and what that will do to our revenue per share growth over the next few years. Now comparing the fourth quarter 2019 average loans to fourth quarter 2018, our growth was nearly 12%. At this time, we have no reason to believe that our loan growth outlook for 2020 will be any less than the high single-digit to low double-digit growth. As you know, we booked about $2.1 billion in loan growth in 2019. We have no reason to believe we won't exceed that in 2020. We make that statement because of the success of our hiring over the last few years, the continued success we anticipate in hiring in our present markets, and the energy that comes to our franchise from Atlanta. Next is an update to our loan pricing. Our loan mix averages approximately 50 to 55% LIBOR prime, with substantially all the LIBOR credit being tied to 30-day LIBOR and about 40% fixed rates, with CRE being the primary contributor. During 2019, the weighted average coupons for LIBOR and prime-based credits for the loan book decreased by 57 basis points for LIBOR and 70 basis points for prime, which is somewhat of a victory given we experienced 75 basis points in rate cuts. So the spreads in these categories actually widened in 2019, inclusive of the rate cuts. Of significance is the spread on fixed-rate credit. As a proxy for fixed-rate spread performance, and to keep it simple, we traditionally use the 5-year Treasury as the benchmark. The 5-year Treasury decreased 82 basis points during the year, while our average fixed-rate loan book actually increased 2 basis points. Now to deposits. Average deposit balances are up $1.7 billion year over year. Our average deposit costs were down 15 basis points in the fourth quarter of 2019 from the third quarter and stood at 1.1% for the quarter. Our charge is continue to reduce deposit rates while at the same time increasing our deposit volumes to fund loan growth and reduce our dependency on the more expensive wholesale funding. To that point, and as we mentioned in the press release last night, we're modifying our annual incentive plan to include a deposit component aimed at growing low-cost core deposits. Similar to prior years, the annual cash plan will still be based on corporate EPS targets, which yield a top quartile earnings per share growth rate within our peer group. We felt like we needed to incorporate into the plan a deposit volume and cost component to energize our entire workforce around accumulating more low-cost core deposits. We're optimistic about this change and how our associates will respond to accomplish this new incentive target. More on deposit rates. Our relationship managers, we believe, did a bang-up job on managing our deposit costs in this rate environment. In the negotiated rate bucket, we've achieved a 32 basis point decline since June of 2019. Our relationship managers are very much in tune with the rate environment and prepared to have more discussions with our client base about rate decreases. At a minimum, we should experience decreases in CD rates for the next couple of quarters as repricing occurs. For what it's worth, our modeling is still suggesting a rate decrease in July and another in November. Our goal is a 50% beta for our interest-bearing deposit book, so we've got a ways to go to achieve our targets, but we are off to a great start. It'll take us a few more quarters on CDs. Our CD book is split about 60% customer and 40% wholesale. The wholesale CDs will roll down fairly quickly, giving us an average duration of slightly more than 6 months, while the customer book will take a little longer as its duration is less than 12 months. As the chart on the right details, through the month of December and excluding CDs, we've experienced 30 basis points in rate declines with 75 basis points in Fed funds decreases or a beta of 40%. If you include CDs, our beta is 32%, but again, the CD beta should increase over the next couple of quarters as CDs reprice. All things considered, we believe overall deposit rates should be down in the first quarter. We do expect downward momentum in rates to be offset by our usual mix change in the first quarter as non-interest-bearing deposit growth is pressured by clients reducing their balances for taxes and other payments that normally occur in the first quarter of each year. As we enter 2020, we're anticipating that our first quarter 2020 margin may be flat to down slightly. We believe we're getting very close to an inflection point related to margin compression. The speculation of a credit cycle change should a recession occur has been on investors' mind for quite some time. Right now, as far as credit risk is concerned, based on our credit metrics and what Harvey and his team tell us, times remain pretty darn good. We've shown these charts before. The chart provides us even more comfort that we're not booking the very large CRE credits. Credit remains at the forefront of our minds, so I hope we never appear complacent when we talk about credit. For the fourth quarter, we experienced probably our best credit quarter in quite some time, with most of our credit-related ratios seeing better results in the fourth quarter and many of the best marks we've posted in several years. So we agree with other bankers that we're not seeing any systemic issues that will cause us to change our perspectives about credit going into 2020. Concerning CECL, I've read a few fourth quarter conference call transcripts on CECL impacts and day one and day two and all that. CECL is important, and we've burned a lot of time and, quite frankly, EPS over the last 2 years getting ready for the January 1st adoption date. To be honest, I'd rather be talking about market share gains and growth and share the excitement we have for this franchise. That said, we're in the final stages of validating the various models we will use to determine the allowance account each quarter. Preliminarily, we believe the allowance account should be less than 70 basis points as of January the 1st, 2020. So as we think about provision expense for 2020, obviously many factors go into projecting provision, including economic forecasts as well as our loan mix. In 2019, excluding charge-offs, if you were to divide our provision expense by average net loan growth, that provisioning expense was approximately 57 basis points for the year. We're anticipating that we will be providing on net new loan growth in 2020 at a rate that falls between the rate of 57 basis points and the day one implementation rate, which, as I mentioned, is projected to be less than 70 basis points. Again, many assumptions, tons. But if that works out, simplistically, the impact CECL will have to our 2020 P&L should serve to reduce our EPS by 1 to 3 cents in 2020 when comparing the CECL methodology to the inherent loss model. Now let's get back to talking about revenues. These totaled more than $263 million in 2019, up more than 31% over 2018. BHG's contribution was up nearly $40 million, or nearly 76% year over year. More on BHG in a second. Our other fee businesses had a strong 2019 with residential mortgage leading the way, up approximately 67% year over year. Mortgage had a great 2019, correlating not only with drops in long-term rates, but also with increases in the number of mortgage originators. Again, great markets are very helpful with this line of business, so we anticipate mortgage to continue with strong growth in 2020. We have no reason to believe we won't see low double-digit fee growth in 2020. Concerning BHG, it's safe to say that BHG had a phenomenal year, and we feel really good about their prospects going into 2020. Originations are at all-time highs, and they expect stronger performance going into next year. As anticipated, BHG began to purposefully keep more of their loans on their balance sheet, thus realizing more interest income rather than relying as heavily on gain on sale as their primary revenue source. They've secured two separate funding sources, which will allow them to warehouse their loans. Thus far, about $175 million in loans are in these two vehicles. As a result, and as anticipated, BHG's revenues were down from third quarter due to more of their loans being held on balance sheet. A quick review on 2019. Originations increased $570 million during 2019, of which $350 million resulted in increases on balance sheet loan balances. You can see on the chart the ranges for growth for 2020 and all of these various areas that BHG is currently contemplating. So there's no slowing down. BHG is at peak performance and intends to stay there. Lastly, concerning the chart at the bottom right, the network of banks buying their credit remains very active. They continue to increase the number of banks in their network, and you can see with little changes to yields and spreads. Specifically as to earnings growth at BHG was tremendous in 2019, and it has a lot to do with better analytics, better marketing, better scorecards, branching into new verticals, and hiring more sales professionals. All of this hit a new stride in the second quarter of 2019. BHG believes a fair earnings growth rate for 2020 is 8 to 12%. As to quarterly growth for Bankers Healthcare Group, we expect first quarter to be very much at the high end of their growth rate when compared to last year's first quarter. We then expect quarterly results to be more or less flatten out for the rest of the year as BHG works the balance sheet strategy and their traditional gain on sale model at the same time. The chart on the right is at the core of many questions we get about Bankers Healthcare Group. With the shift to more of a balance sheet model, you can see that they will not abandon gain on sale, but believe they can reduce its impact and thus diversify BHG's revenue stream, which is at the heart of the strategy. Diversification of the revenue stream as well as diversification of their funding sources. They are targeting a longer-term target of interest income as a percentage of total revenues of more than 40 to 50%, but suffice to say, to get to 35% over the next 2 to 3 years would be a tremendous accomplishment. So now briefly on expenses. As we note here, salaries up largely due to increased personnel and increased award levels in the incentive plan in 2019 versus 2018. Equipment and occupancy are up year over year due to increased technology costs and the branch rationalization project that we began and completed in 2019. As to our run rate moving forward, using the fourth quarter as a base, we're anticipating expenses to increase in the mid-single-digit range in 2020. We've got a big hiring plan this year, inclusive of Atlanta, which Terry will go into more detail in a few minutes. For the last few years, our expense to average assets, excluding merger, has been in the 1.9% range. We don't see that changing much at all in 2020. As I discussed on last quarter's call, we've modified our longer-term operating ranges. Our previous metrics were in place since 2012. We believe the granularity provided by those previous measurements served its purpose, so we're now opting to go with a higher level of guidance with operating ranges for ROAA, ROTCE, and tangible equity as our current guidepost. For ROAA, we're targeting 145 to 165 for the fourth quarter. We're operating slightly outside that range at 139, but anticipate getting back in within the range fairly quickly with BHG's strategy change becoming less impactful to linked quarter results and as Atlanta builds out. ROTCE should also respond in a similar fashion. We're also operating in the high end of the range on tangible equity ratio. Just to remind everyone, we've operated outside our published ranges in previous years, albeit they were the previous targets. I think it took us 2+ years to get to our non-interest expense target in the early days. Same is true today, although we're thinking it'll take only a few quarters. The communication objective here is that we will find our way back to these ranges quickly. With that, I'll turn it back over to Terry to talk about our outlook for the Atlanta market.
Okay, thanks, Harold. As most of you know, we've generally targeted the largest, fastest-growing urban markets in the Southeast. For some time, we've used this map to illustrate our desired geographies. There are 15 urban markets that were originally targeted in this triangle from Memphis to D.C. and from Memphis to Charleston, South Carolina. Today, we're operating in 10 of the 15, and it's our expectation that we can generally produce double-digit loan growth with no further market extension. In other words, we expect double-digit growth from the 10 blue markets in which we currently operate. That's a pretty enviable position to have built a current market presence that should yield double-digit growth. In general, we've been operating right through the core of this triangle, but not at the fringes. So the remaining targets include Atlanta, Georgia, and Columbia, South Carolina to the south, and the Hampton Roads area of Virginia, Richmond, Virginia, and Washington, D.C. to the north. In my judgment, easily the most attractive of those remaining targeted markets is Atlanta. Obviously, we've chosen these southeastern markets because of their size and growth dynamics. They support our aspirations to build a large, high-growth bank, and we've chosen them because they're familiar to us. We understand how business is done in them. Frankly, I love our model, but I'm not completely sure if it would be as effective in, say, New England as an example. Beyond our familiarity with them, we've chosen these markets because of our confidence in our ability to attract the best bankers and provide distinctive service to their clients, and that yields huge market share takeaway, specifically from those large vulnerable competitors that currently dominate all these markets. So in short, from a strategic standpoint, we target large, high-growth urban markets that are dominated by Wells Fargo, SunTrust, Bank of America, and Regions. That's why I say, in my judgment, Atlanta is easily the most attractive market to which we can extend. It's the largest, fast-growing market, and it's dominated by Truist, Bank of America, and Wells Fargo, all of whom seem incredibly vulnerable at this time. Honestly, I view this as a once-in-a-generation opportunity to grow a big bank in one of the nation's most attractive markets, perhaps even more exciting than the opportunity we saw and have seized in Nashville. I don't really want to spend a lot of time selling the Atlanta market. I expect most everyone's familiar with its size and growth dynamics, but quickly, it's the 9th largest MSA in the country by population. It's the #1 moving destination in the nation for the 9th consecutive year. Its median household income is consistently more than 50% higher than the Southeast MSA median, more than 50% higher. And it's an extremely rich market for businesses, which is the thrust of our firm. There are 26 Fortune 1000 companies headquartered there, 16 Fortune 500 companies, and 200 of the nation's fastest-growing private companies. Specifically, there are nearly 24,000 businesses with sales from $1 million to $500 million, which is our target market and where we excel. Not only are the size and growth dynamics of the Atlanta market overwhelmingly attractive, frankly, the more compelling attribute is the competitive landscape. It's a market in a dramatic state of turmoil and diminished brand loyalty across the board. 60% of the top 20 banks in 2009 are no longer in the market. 40% of today's top 20 are there by way of acquisition, and many still exhibit the vulnerability typically associated with merger and integration. Not only that, but I'm in possession of the Greenwich research on client satisfaction with banks in the Atlanta market. It would suggest that even prior to the announcement of the SunTrust BB&T merger, the client satisfaction at those big banks that dominate the Atlanta market is even worse there than it is for them in Nashville, where we've been so successful taking their share. So the opportunity is right. So instead of wasting a lot of time building a case for the obvious, the attractiveness of the Atlanta market, I'd really prefer to spend more time on our vision for Atlanta. what we intend to build, and how we intend to do it. The best illustration of that is what we've already actually done in Nashville, another relatively large high-growth market, absolutely dominated by Bank of America, SunTrust, and Regions, or its predecessor, AmSouth, back in 2000 when we started Pinnacle on a de novo basis. Many of you will recall that the catalyst for our forming Pinnacle was the sale of First American Corporation, a $20 billion bank holding company headquartered in Nashville, and the last large locally owned bank to be rolled up by out-of-state headquartered banks, in that case, AmSouth. It seems to me the parallel to Atlanta is obvious. Bank of America, SunTrust, and Regions each had 15 to 22% deposit market share in Nashville when we started. I'll personally never forget Don Kennedy of Kennedy Roofing Company coming in and opening our first checking account and our first line of credit. That was it on October 27, 2000, one client. In other words, we had nothing when we set our sights on those three dominant banks. So this chart paints a pretty vivid picture of what we've been able to do since that time and how we've done it. In terms of what we've done, at June 30, 2019, we continue at the top of the FDIC deposit share chart where we've been for a few years now. And my goal is not to gloat about our success or disparage our competitors, but I need to make sure I'm clear about the magnitude of the market share takeaway because it bears on the success we're targeting in Atlanta due to the competitive vulnerabilities we just discussed. As you can see on the FDIC chart today, Regions has roughly 12% of the deposit market in Nashville. Regions today represents the combination of what was once Regions, Union Planters, and AmSouth, which on a combined basis had north of 30% market share in Nashville when we started in 2000. So that's an 18% market share give up by Regions and its predecessors since we started. And I'm not going to go through and highlight each competitor, but it suffices to say virtually all the big banks that dominated the market when Pinnacle started from scratch in Nashville have given up market share from which we have successfully grown. More importantly, look at the Greenwich Associate data on the top right of the slide. First of all, this is data regarding businesses with annual sales from 1 to 500 million. What's plotted here is lead bank share for the 5 banks with the largest business share in Nashville and the level of satisfaction that their clients express about them. Let me start with the lead share position. As you can see today, we're in a first position at the top of the chart, and not by a little, by a lot. Roughly 26% of the businesses in Nashville view Pinnacle as their lead bank. Our next closest competitor has just 10% share. That's a pretty commanding lead for having started at zero. And then focusing on what our clients think about the differentiated level of service we provide them, roughly 90% give us a top box rating, while some of our competitors receive a percentage of top box scores from their clients down in the 50s range, which is a phenomenon that suggests to me, regardless of our already dominant position, there's still meaningful ongoing market share takeaway opportunity in Nashville, which I'll develop further in just a minute. Now, at the bottom left of the slide, we focus on how we take so much share from these large vulnerable competitors. According to Greenwich, the attributes down the left side of the chart are the things that are most valued by business clients. As you can see from the key, the darker green the box, the more dominant you are versus competitors on those items that matter most to businesses. And the brighter red the box, the more vulnerable you are to competitors on those same items. As you can see, we dominate the Nashville business market in terms of how easy we are to do business with, how effectively we're able to demonstrate that we value long-term relationships, the Net Promoter Score, which is generally the measure of a client's desire and willingness to recommend us to their peers, and our overall digital experience. I don't want to get too far from my central message here, but there's one I can't resist highlighting. That's our client's view of our digital channel offering. As a business-focused bank, I love our number one position in the national market as it relates to our business clients' overall regard for our digital channel offering versus how the business clients of Truist, Bank of America, and Wells Fargo regard their digital channel offering. All right, that's enough of that. Setting aside that, as you continue on down the chart, you can see the power of our unique hiring model as our relationship managers dominate. And then finally, our treasury management systems also dominate the national market against these larger regional and national franchises. Looking now at the lower right of that chart, I won't walk you through each aspect of our execution in the market, but you can see that businesses who aren't currently our clients hold us in extremely high regard, which speaks to the ongoing share takeaway potential I mentioned a minute ago. And our existing clients favor us with more business than the clients of our competitors favor them with their business. As I mentioned a couple of times now, it appears to me that despite our dominant position, we still have meaningful market share takeaway opportunity in Nashville. Our ability to seize the vulnerability at these large banks is still picking up speed. As you can see, our lead bank share in Nashville grew 3% last year. 3% lead bank share just last year. This model of hiring the best bankers in the market away from those large vulnerable competitors and then getting them to move their book of business by enabling them to focus on what clients value most continues to be a winning play against the banks that used to dominate Nashville and currently dominate Atlanta. So this is our aspiration in Atlanta in the next 5 years. We expect to aggressively recruit and hire the best bankers in the market from the large, vulnerable regional and national competitors. More specifically, not dissimilar to the hiring approach we took to building our C&I focus in the Carolinas and Virginia. We expect to hire at least 10 relationship managers a year or 50 over a 5-year period of time. We intend to arm them with the same treasury management, wealth management, and differentiated back office service levels that have been so effective against those banks that dominate the Atlanta market. Specifically, that would entail hiring roughly 15 to 20 additional revenue producers over the 5-year period as treasury management consultants, wealth managers, brokers, mortgage originators, SBA loan originators, and the like. We'd expect in general to open an office a year in the business-rich trade areas of Atlanta, places like East Cobb County, Buckhead, North Fulton County, just to name a few. We think we can build out a $3 billion bank in the Atlanta market over the 5-year period. We expect to invest 3 to 4 cents in EPS during 2020 and cross break even in the third quarter of 21, about an 18-month break-even period. After a lot of dialogue with a number of candidates, we selected Rob Garcia to build out our bank there. Over the years, as I've discussed the Atlanta opportunity, I've always indicated that our goal wasn't just to build an LPO or to just hire a small sales team, but to hire management that was capable of operating across all banking disciplines and that was capable of building a $2 to $3 billion bank. Rob has demonstrated an ability to do that. He's a long-standing banker in the Atlanta market. He has been the Atlanta market president for Synovus, where he was running a roughly $5 billion bank. Prior to joining Synovus by way of acquisition, Rob was instrumental in starting Riverside Bank, a notable startup there that was sold to Synovus in 2005. So Rob is uniquely qualified from our perspective. He's well known to Pinnacle's Nashville-based chief credit officer based on their previous working relationship in Atlanta. He's worked in a larger regional bank environment, which gives him fluency in all the sophisticated products provided by Pinnacle and those large regional and national franchises. But he has a thorough understanding of the community banking model that Pinnacle uses to differentiate itself from those larger banks. Since joining us in late December, he's already hired 3 highly successful relationship managers, 1 C&I lender, 1 private banker, and 1 CRE lender, along with their key support personnel. And the hiring pipelines appear to be filling up pretty rapidly. So we're off to a fast start and excited about the incremental growth opportunity the Atlanta market provides us. As I said earlier, we view this as a once-in-a-generation opportunity, and we intend to make the necessary investments to seize it. So, we're extremely excited about our prospects in 2020. Here's what we're targeting. Continued double-digit loan growth, similar double-digit growth in core deposits, while we continue to bid our cost of funds down, and low double-digit fee growth. Longer term, we intend to capitalize on the economic and competitive landscape in our target markets, which is fabulous. Continue hiring revenue producers throughout the footprint, and additionally in Atlanta. That's always been our revenue growth engine, and honestly, it's never looked better. And finally, to continue to grow tangible book value, because it's my belief that companies that can compound tangible book value grow their share price meaningfully. So, Sheree, with that, we'll stop and take questions.
Thank you, Mr. Turner. The floor is now open for your questions. If you would like to ask a question at this time, please press star, then 1 on your touch-tone phone. Analysts will be given preference during the Q&A. Again, we do ask that while you pose your question that you pick up your handset to provide optimal sound quality. Our first question comes from Jennifer Demba with SunTrust.
Good morning.
Hi, Jen. Hi, Jen.
Terry, the Atlanta expansion makes a ton of sense for you guys. Do you see a potential other de novo effort for Pinnacle in the next few years if opportunities should arise, or do you think you'll try and just focus in on Atlanta and focus in on Atlanta?
That's a great question. Jen, as you know, I'm hesitant to make comments about, we're always going to do this or we're never going to do that or those kinds of things, because opportunities change, landscapes change, all those kinds of things. So I don't want to put myself in a position to say, we just wouldn't do another de novo expansion. But having said that, and to put it in context, to be honest with you, sitting here right now, my thrust is Atlanta. It's an unbelievable opportunity. It's what we want to work on. You know the market better than I do, but it is so large and high growing, and the competitive landscape is so right, and what we do is so well suited to the opportunity. That just becomes sort of the top of my list of what I want to work on. And so, as a company, that's where we'll dedicate a lot of resource, and quite honestly, that's where I'll personally invest a meaningful amount of time.
Okay. And can you talk about, Harold, you mentioned something about the growth rate for BHG in the first quarter of 20, and I don't think I understood it. Could you repeat that?
Yeah, trying to build off the fourth quarter of 2019, but also compare it to the first quarter of 19. We think the growth rate for the first quarter of this year will at least be 12% over the first quarter of last year.
Okay. And any thoughts on a tax rate for 2020?
Yeah, we don't anticipate the tax rate to change very much in 2020. The ETR ought to be pretty similar.
Great. Thanks a lot. Good quarter.
Thank you.
Thank you.
Thank you. Our next question comes from Steven Alexopoulos with J.P. Morgan.
Hi, good morning, everyone.
Hey, Steven.
I wanted to start first on the margin. Harold, I thought you said the NIM would be flat to down in 2020. How do you think about the NIM over the near term?
Yeah, that would be for the first quarter.
Oh, so that is the first quarter.
Yeah, we think it won't be down much if it goes down. So we're close to that inflection point here within the first half of the year.
Got you. And then stabilize beyond 1Q20.
That's our current planning assumption, Stephen. We've still got a July rate cut in there. Whether or not that happens or not sure. But we did a lot of call it initiatives last year to kind of reduce our asset sensitivity. And that has basically neutralized our balance sheet with respect to rate cuts.
Mm-hmm. Got you. Okay. And then on the Atlanta expansion, I'm curious, how many relationship managers do you expect to add in 2020, and how did you come up with 50 as the right overall number?
Yeah, I guess the thrust is sort of how fast can you hire and assimilate people. And so I think, again, in working with Rob Garcia, who's our market leader there, it felt a comfortable pace to us to hire 10 relationship managers. And I think you might think about it this way, Stephen, they would be maybe a number like 6 C&I bankers in the 10, maybe a number like 3 private bankers in the 10, and maybe a number like 1 CRE banker in the 10. And so that seemed like a comfortable build-out pace for us. And so it's just simple math from there. 10 a year, 5 years is 50. That's not to say we wouldn't hire more if we had the opportunity, which we may well have. But that's sort of the core of what we're trying to do as we build a C&I platform. I also indicated that we'll build out the other fee business professionals as well, which would include treasury management, consultants, wealth managers, primarily brokers, mortgage originators, and SBA loan originators, and so forth. And so compared to the 50 over 5 years, that's probably another 15 to 20 revenue producers that would be added to that.
Okay. That's helpful. Then just one final question. So looking at the loan growth guidance for 2020, you included high single digit in the range. Are you just being conservative, or do you see something that could cause loan growth to slow this year? Thanks.
Yeah, I think it's more about being conservative than it is, any kind of statement regarding what kind of energy we have within the franchise. We did $2.1 billion. We ought to at least do that here going into 2020.
Okay. Thanks for all the color, and thanks for taking my questions.
All right. Thanks, Dave.
Thank you. Our next question comes from Catherine Mealor with KBW.
Thanks. Good morning.
Hey, good morning.
So, Harold, in your earlier remarks, you talked about how your incentive plan relies on EPS growth versus as you compare it to peer EPS growth. And so as we think about what we're seeing across maybe consensus across mid-cap banks, there's generally flat to maybe even down EPS growth for most of your peers. So how do we think about and I know you're not going to give us your goal, but just conceptually, is it fair to assume that there is some level of EPS growth in 2020 over 2019 to get a full incentive compensation payout this year?
Yeah, I think that's a fair assertion. There's quantitative and qualitative factors going on. You're right. When you line up our peer group, there's probably half of them that are now with estimates out there for negative earnings growth in 2020 over 2019. So you might say, well, it's kind of like stepping over a rock or something to get to top quartile. But at the end of the day, when you line it all up and you start thinking about, okay, how are you going to propel these shares? What's going to make these shares move? What kind of catalyst might be there? And so we use that incentive plan to help create that energy. And so you should assume that there's going to be outsized growth. And I think if you line up our peers, you can probably see, what kind of targets we're shooting for. So
great, that's good.
I don't know if I got to your question, but that would be my my response.
No, you do. I think that's right. I think I would assume that there's some level of EPS growth, for you to get a full payout. But just wanted to kind of confirm that. That makes sense. And then maybe a follow-up on that, I'm just thinking about the expense build-out. I mean, if we take your 3 to 4 cent EPS investment for Atlanta, that's about called $3.5 million, which is a very small piece of the overall expense growth this year if you kind of do it on a dollar basis. So where is the rest of the expense growth coming from? Or is there some kind of revenue component also in that 3 to 4 cent investment?
Well, there definitely is a revenue component. So Terry's not been bashful with Rob and assigning, growth rates and all that sort of stuff. So he's got himself, a full-time job. I'll say it like that. So there is revenue growth in that number for Atlanta. The expense growth, we've got a significant hiring plan coming up on us, and that comes with an additional incentive costs and all that. But that also gives us flexibility with some respects. So, the easiest thing we can get kind of quick returns off of with respect to our plan is to throttle back on expenses or otherwise use that incentive plan to help us perhaps offset revenue shortfalls. And we've done that in the past. So 2020 will be no different. But what we're speaking to today in our comments is a fairly significant hiring plan that we've got going into next year.
Hey, Catherine, I might just add to Harold's comments there. Jennifer Denby asked a great question, really about, okay, so would you take on other de novo opportunities in addition to Atlanta? And again, that's not in our plan. Our plan is to focus on the markets that we're in, plus Atlanta. But I wouldn't want anybody to lose sight of, we're still building out a lot of revenue capability in markets like Charlotte and Raleigh and Greenville and Charleston. And I think you probably saw in the fourth quarter, I think we added 18 revenue producers in the fourth quarter alone last quarter, fourth quarter of 2019. And so we're still believing that this competitive landscape is right up our alley, and we're still finding great opportunity to hire banks largely from these large banks that we view to be so vulnerable. So anyway, I'll just give you that as color on the expense bill.
Got it. That's helpful. Great. Thank you so much.
Thanks, Kevin.
Thank you. Our next question comes from Stephen Scouten with Piper Sandler.
Hey, guys. Good morning.
Hey, Steve.
I'm curious. I think you said on CECL, maybe it was a 1 to 3 cent kind of drag into your 2020 expectations. So does that imply you think credit trends should kind of continue at their current pace, and I guess provisioning would be in the $30 to $35 million kind of range based on that math?
Yeah, I don't think that's too far off. We spent a lot of time with the credit administrators trying to figure out what kind of charge-off forecast they might have for 2020, and we're just not seeing anything that would alarm us that we're going to see increased provisioning related to the charge-offs for 2020.
Got it. Okay. And then kind of digging further into some of Catherine's questioning there, just you guys noted a little bit below the ROA target here in the fourth quarter, but obviously not for the full year. You did a great job on the full year relative to that target, but it seems like it'll be difficult really to deliver EPS growth year over year given NIM headwinds, mid-single digit expense growth, and maybe a dip into the high single digits on the loan growth front. How I guess, confident are you around that ability to grow EPS year over year, apart from maybe, a reduction in incentive comp?
Yeah, I think it's going to be a hard year. Obviously, the yield curve's not helpful, or it's improved some over the last, short-term period here, but the confidence we have is, goes back to the core. It's about what markets you're operating in and what kind of objectives you lay out on these people to say, okay, what's that old saying that without an objective, any path will get you there, or something. You just got to kind of lay out these goals. I think there was a question earlier about how do we get to 50 people. Well, a lot of that is just sitting down, going eyeball to eyeball with people and saying, hey, you got to do this for us to get to the numbers we need to get to. So we lay that out there and say, okay, you need to hire this many people. That's the way we've operated this firm now for almost 20 years. And we think that at the end of the day, our folks will deliver what we've tasked them to deliver. It's not that difficult, actually, as to how we operate this firm.
Stephen, I might add to Harold's comments, just for whatever it's worth. This, nobody knows the future, including me, and I don't know what all the market conditions are going to do and how they might change and what the impact of the political discourse in the country is going to be, or what the impacts by North Korea, Iran, or all those sorts of things. But if you're talking about an environment that looks very much like the environment that we're in today, I can't imagine this country's not going to produce earnings per share growth.
Okay, great. And then just maybe last thing, I'm curious, you guys still have a pretty sizable authorization on the share buybacks, a little less active this quarter. When you're modeling and you're thinking about the company for next year, how are you thinking about capital planning and the share repurchases in particular?
Yeah, we're still planning on using the rest of our allocation. We're likely to use it, here over the next 3 quarters. So or 4 quarters. We intend to use it.
Okay, great. Thanks for the color, guys.
All right, thanks, Steve.
Thank you. Our next question comes from Jared Shaw with Wells Fargo Securities.
Just looking at the BHG with the color on first quarter, should we expect then that the rest of the year the growth is sort of a steady ramp from there, or will it be a little lumpy?
Yeah, Jared, we've had a lot of conversation with BHG over the years about lumpiness. I think the way it's kind of planned out this year, or what they're shooting for, is that you'll see a ramp up from the fourth quarter into the first quarter, and then a ramp up into the second quarter, and then that growth rate will basically be flattish to slightly up for the rest of the year. So it's been somewhat of a bell curve for a few years. And so I think this year they're planning on a kind of a ramp up in 1, 2, and 2Q, and then kind of flattish into the last half of the year.
And do those two funding facilities, does that provide enough funding for them to meet their goals, or is there an expectation that they're going to get additional funding as we go through the year?
Yeah, the plan for them is to fund up here fairly quickly, and then what they'll do is they'll securitize. They've got a $200 million facility. They'll securitize that facility and then, in effect, sell it off to investors, not the asset, just the funding part. They'll borrow money to set up a security, and then they'll reload the warehouse.
Got it, great. And then on the margin, with your expectation for a July cut there, if we don't see a July cut, is that incrementally positive to margin in the second half, or are you running neutral enough now where it should be relatively neutral overall?
Oh, I think it'll be positive. I don't think it'll be a big positive, but I think it'll be positive.
Great. Thanks very much.
Thanks, Jared.
Thank you. Our next question comes from Brock Vandervliet with UPS.
Good morning. Thanks for the question. Just to follow up on those. So if I understand this, BHG's funding is now set between what they've got organically in terms of the balance sheet runway plus the securitization strategy. Is there any missing piece that's left here, or are they set?
I think they're pretty much set. I think they're still working through documents on the securitization piece, but they intend to, in the second quarter, to kind of do that first issuance.
And did Pinnacle expand its financing of BHG, or was that unchanged?
I don't think it has changed.
Okay. And Harold, I think you've done a good job in terms of orchestrating this shift we see in funding, running down some of the CDs. How much more can you go on the wholesale CD front? Remind us how large that portfolio is.
Yeah, hold on. Give me a second. I'll try to dig the numbers. I appreciate the compliment in front of Terry. That's good.
Brock, I was kind of hoping for one, too. If I could get one, that'd be good.
I'll work on it.
The CD book we're probably talking about, $300-400 million.
Okay.
Is that about 110? Or I'm sorry. No, wait. I'm sorry. I'm talking to you wrong. Probably about $2 billion in CDs.
And how much of that's wholesale?
I think basically $2 billion is about wholesale. I've got 1.7 in brokered and about 800, call it non-core retail, about 800 million in that. So
okay.
I'm saying that's kind of my wholesale book.
Okay. And Terry, I'm not sure this is a compliment, but you're obviously no stranger to acquisitions. As you looked at the Atlanta market, clearly you've got a horse there you found with a leader, but how did you evaluate that versus a possible acquisition?
Well, I think I'd say there's 2 or 3 things that are important to me. Goal 1 is to get to the market. You know, we've sort of had it as a target for a long time, but the vulnerability really accelerated in Atlanta over the last 12 months in the competitive landscape. And so it just got important to me to get there. I'm not insincere when I say it may be as big an opportunity as the one we seized in Nashville. So then underneath that, obviously we have discussions about M&A and about a de novo model. I think I've said all along I'd be prepared to go either way. I still say that would, reflect my mindset. I would have been willing to go either way. It gets back to, can you hire somebody? How big a book can they build? And then if you do an M&A transaction, what are all the ongoing implications of that? What's the price going to be? What's the accretion going to be? All those kinds of things. And so, at least at this moment, the de novo start felt best to us.
Got it. Okay. Thanks for taking my questions.
All right.
Thank you. Our next question comes from Tyler Stafford with Stephens.
Hey, good morning, guys.
Hey, Tom.
Hey, just 2 more for me. I just wanted to follow up on the inclusion of the core deposit growth within the incentive plan. How much weighting does that carry in the plan this year?
It'll be a similar weighting to the revenue share that we've had in prior years. So it'll be around 20% or so.
Okay. And then I just wanted to clarify, as you guys pencil out the 2020 year with the guidance and outlook you've laid out, you do think that you can get back within your ROA and ROTCE target range over the next couple quarters with that July and November cut assumption?
Yeah, I think so. I think the ROAA target will be it'll be a little easier than the ROTCE target, but we still think that our modeling shows that we'll get back within.
Okay. Should there be any much balance sheet, the difference between kind of loan growth and overall balance sheet growth, would that differ much? Or total balance sheet growth should still be kind of high single digits, low double digits?
Yeah, I think balance sheet growth and loan growth will run kind of similar growth rates.
Okay. All right. Thanks, Harold.
All right. Thanks, Tom.
Thank you. Our next question comes from Brian Martin with Janney Montgomery.
Hey, guys. Good morning.
Hey, Brian.
Hey, Harold, just one thing back to the margin. I mean, if you get the 2 cuts, if you don't get the 2 cuts that you expect, I guess, is there upside to the margin? Is that how we should think about it, given kind of the plans you've outlined? Sounds like stable with the cuts, and then maybe some upside if you don't get the cuts.
I think it is that way. I think there's going to be a slight positive to a no cut environment or a flat Fed funds rate for the year. We did a lot of work last year to, like I said, remove asset sensitivity. So I think we're much more neutral with respect to interest rate risk management this year.
Okay, perfect. And I think you said on the expense outlook that it's a mid-single-digit growth rate. Is that off of 19, and does that include the Atlanta, the Atlanta build-up, the cost for that?
Yeah, it's off of the fourth quarter run rate.
Okay.
And it's got a component in there for Atlanta.
Okay. All right, and then last thing on the clarification on BHG, I think the revenues I thought your comment was that the revenues in BHG are up 8 to 12% in 20 versus 19. In 2019 was like a $90 million number. Is that the right math, how we're thinking about that?
Yep.
Okay. All right, that's all I had. Thanks so much.
All right, thanks, Brian.
Speakers, I'm showing no further questions in the queue at this time. I will now like to turn the call back over to you for any further remarks.
All right. I would just say that our view was fourth quarter was a good quarter for us. It's really highlighted by the improvement in cost of deposits, continued balance sheet growth, and continued hiring. And our outlook for 2020 continues to be strong, running exactly the same program with the addition of the high-profile Atlanta market. Thanks for joining us.
Ladies and gentlemen, this concludes today's conference call. Thank you for your participation. You may now disconnect.